In this video, you will learn number one about Deriv synthetic indices and how they operate on the chart. And number two, I'll be teaching you how to create a Deriv account so that you can start trading Deriv synthetic indices. Number three, I'll be teaching you how to trade synthetic indices on MetaTrader 5. And in number four, I will also be teaching you how to choose synthetic assets on MetaTrader 5. And a lot of them. We have a lot of them in the market. Number five, I'm going to be teaching you the differences between Deriv synthetic assets because not all synthetic assets are the same in the market. Then in number six, I'll be teaching you the best time frames for trading synthetic indices in the market. And in number seven, I'll be telling you the only two ways that you can trade synthetic indices. In the last one, I'll be giving you the best trading strategy that you can use on synthetic indices to start making money from it today. Alright, let's get to it. Alright guys, so first of all, I'm going to be telling you about how Deriv synthetic indices work and everything about Deriv. Before we proceed to the sign up, how to log in on your MetaTrader 5 and the different strategies that are used to trade the market with Deriv synthetic indices, and a lot that I'll be teaching you in this video. So the first thing you have to know is what is Deriv, and what are Deriv synthetic indices. Deriv is a broker that offers these synthetic indices as their own assets. That means you cannot be able to find these indices on any other broker apart from Deriv. So these indices are not like GBP USD, these currency pairs that you can find it anywhere. These indices are only found on Deriv, and there are lots of them. Why should you choose Deriv synthetic indices? Number one is because Deriv synthetic indices are very, very much simpler to analyze. Like, take a look at this chart right now. You can see the way this chart is. This is volatility 75, one of the synthetic indices that we trade on Deriv. You can see it. Look at how it moves. Now, let me show you a currency pair like GBP USD. Look at the formations. Look at the formations. Let me show you another currency pair. Euro USD. Now, look at the way these assets are moving. They are moving like they jump a lot. There are a lot of gaps. There are a lot of confusions on this chart. It is much harder to analyze. But when you are trading Deriv synthetic indices, you can see that everything seems to align smoothly. The way the charts are moving, you see everything is smooth, more smoother than the one you see on currency pairs. And that's the reason why a lot of traders love trading synthetic indices. When you are trading synthetic indices, there's this peace of mind that it gives you. Like, inside your mind, you know that, yeah, this one is much easier and better to analyze than currency pair. There are many reasons why you won't make it with currency pair. And number one is trading strategy. Number two is news trading. The news you can just be in a trade like something like this place now. Look at this place. Let's say you are in a trade, you analyze this market to go down, and all of a sudden a news just enter and just swallow your whole profit. Within 1 minute, your whole profit is taken out just like that. So those are the type of things that we are trying to avoid, and that's the reason why you are trading synthetic indices. And another reason is that when you are trading with currency pairs, you are only limited to trading from Monday till Friday. But with currency pair, you can trade every time. Just like we just had Easter and Easter celebration, the market was closed for a day. That is on Monday, the market was closed, nobody could trade. But Deriv synthetic indices is still moving smoothly. They don't care about anything that is happening. Their indices are always moving 24 hours, 7 days a week. You have everything here. There is no break, there is no news taking your trades, and there's no large spread. Like, take a look at this now. When you enter a trade on Deriv, there is no spread. You can see this. There is no spread when you are trading Deriv synthetic indices. The place that you enter your trade, that's where your trade starts to count. But with currency pair, you will need to pay for spreads. Sometimes you are in a very big loss even before you enter a trade, but it's not like that with derived synthetic indices. And that's the reason why I love trading synthetic indices. And that's the reason why a lot of traders are trading synthetic indices. But the truth is that they will not tell anyone. A lot of them are keeping it a secret. And that's the reason why many people are not enjoying this synthetic indices, these assets in the market, because the ones who are trading it and making profits with it are keeping it a secret. But on this channel, I'm going to be revealing all the secrets on this channel. In the next videos, I'm going to be teaching you guys trading strategies on different assets of derived synthetic indices, including boom and crash, volatility, jump, and many other assets. The reason why many traders enter Deriv is to be able to trade the derived synthetic indices. Although they are also good with currency pairs, they give you good spreads, they give you everything. So now that's it about the difference between currency pairs and derived synthetic indices. Now, how can you start trading derived synthetic indices? The first step is to sign up with Deriv Broker. So to sign up with Deriv Broker, the first thing you do is that you go to the link in the description box below. You click on the link. So when you click on the link in the description box below, it's going to bring you down to this page. So right now you select your country. For me, I'm a Nigerian, so I select Nigeria. Then you hit the sign up button. Click on sign up. You can sign up with your email, with your Facebook, with Apple and the rest. But I prefer you go with your email. Just type the email address that you want to use. Alright. So after typing the email address, you click on next. Now it starts to load. Now you have to enter the 6-digit code that was sent to your email. So when you have typed in your code, the next thing is to add the password. The next thing is to add the password. So you can choose any password that you want. Then you hit on the create account. You can see we have try real trading, try demo trading. Go with try real trading. You can still do the demo later. So when you are at the try real trading page, it will lead you to this page where you put your first name, your last name, date of birth, and the rest. At this point, I'll leave it to complete everything by yourself. And when you do that, you click on next and you fill out every detail that they ask you to fill.
Now let's move to MetaTrader 5.
And the next step, which is to come down here, click on this plus button here. And when you've clicked on this plus button, you can choose the name that you see on your Deriv account details, the account details that you will get on your Deriv account. If the name is not appearing here, you can search it. So you just click on put Deriv there, search Deriv there, just put Deriv there for me, and you will see a lot of Deriv. You see a lot of servers that you can use. Now, so you make sure you pick the one that is on your account. Very, very important. Like, let's use this one. Every detail that was given to you on your account is very, very important. When you come here, you can see that there are a lot of servers. We have server O2, we have different servers for your account. You'll be given the server on your Deriv account when you open a real trading account. So here you can click on you can now enter the account number, and then you enter the password, and then you log in. When you logged in into your account, you are going to get your quotes. First of all, you just have some Deriv assets. In order to add the asset that you like, you go down to this plus button, and here you can see a lot of assets. There are lots of Deriv assets now. I remember when we started, it was only jump, boom and crash, volatility indices, and a few others that we have. But right now, there are lots of Deriv synthetic indices. We have spots. You can see we have spots, spots of volatility down. There are lots of them. We have drift switching indices. Look at them here. We have basket indices, Euro basket, GBP basket, a lot of indices on this place. But the ones that I like to trade the most for me is volatility. I like trading volatility indices, and I like trading boom and crash sometimes. But the major one that I trade is volatility indices and then jump indices. As you can see here, look at the asset that I've selected. Sorry. So if you want to select the asset that you want, let's say you want to add boom and crash. There are a lot of boom and crash here. You just click on this plus button here, and it will be added to your assets. Look, right now I have boom 150 here. So if I want to enter it, I just click on it, click on charts, and I'm in. Allow it to load because this is the first time you are placing it on your chart. So it will load for a bit, and it will now open, and you'll be able to see the chart and analyze. If you want to add more assets, you can also add more assets. Like, let's say you want to add them volatility indices. All right. So here we have 100 oneness. We have volatility 100. You know. So if you want to add 100 oneness, you just click on this plus button, and it will be added. Scroll down, you'll see it below. So you click on chart, and you will see the assets. Like I said before, you have to give it some time to load. All right. Now we have boom here. Boom 150. Look at it. So here we have boom. On the chart here, you can see the way it looks. Let's see, volatility has loaded. Volatility 101. Okay, that's loaded. And here we have volatility 100. Look at it. Now, if there are some indices that you have in mind before you entered, if there are some indices that you had in mind, you can also add them. Like, some people like trading step index. You can add step index. Click on the plus button, and you add it to your chart. So now that's it. Step index, you have step index here. Allow it to load, and it will load. Then after that, you can start trading it. Now, let me tell you something very important. If you want to see more assets on your chart, okay, let's say you want to arrange your assets, you want boom to be at the top, you can just scroll them up. See what I did there? You hold it, then you scroll up, place it in the position that you want to place it. You can see, but that's not what I'm here to do. These Deriv assets are very, very, very different from each other. They are not the same. All of them works in different ways. Like for example, trading boom and crash is very different from trading volatility. Currently here we have crash 1000, and look at the way it moves. This chart is I won't lie to you, is kind of very much algorithmic. This chart is kind of very like, it's like algorithm. Have you seen where people would program coding things? Like there's this game, I've forgotten the name of this game. Um, I think this Minecraft. I think, yeah, Minecraft. So this the way it moves like all this Minecraft stuff. But I tell you, a lot of traders are making money from this particular asset, boom and crash. This one is crash 1000. Let me show you crash. Let me show you boom. So here we have boom 500. Let's let it load because I just added it to my assets. So let's allow it to load a little bit. Okay, now we have it. So you can see that this boom and crash, they have a lot of similarities. Look at that stuff I was telling you guys earlier. So look at this spike here. Boom are known for making spike. That's why they are called boom. And when you look at this point on the chart, this place where you see boom 500 index 15 minutes, you see that they write something there. They said on average one spike occurs in the price series every 500 ticks. Now this stuff is very different from other assets. Like if you go on step index now, you will see their own. They are like warning you, telling you how it works, so before you start trading it. So here we have step index 15 minutes, and what did they tell you? They said equal probability of up and down with fixed step size of 0.1. That is, it has an equal probability of going up and down in a fixed step price. Although this one is just like telling you the features of this asset that you're about to trade. But what they are telling you does not matter on the chart. What matters is your trading strategy. And that's what you're going to be working with when you're trading derived synthetic indices. So you have to know the differences. Let's look at volatility here. Volatility 101 is, what did they tell you? They said constant volatility of 100% with a tick every second. You can see, so that's about the asset. If you go down to jump, like let's see jump 75 here, what they tell you, they said an index with 75% volatility and 3 jumps per hour on average. So when you are trading this asset, you are expecting at least 3 jumps. What do they mean by jumps? Jumps means that spike, like something like this one here, this spike here, or this one. That's what they mean by the jump. So if you are trading this asset, you should be aware. They are telling you before time, they're telling you this is how this asset works. So you know what you are trading with. Now, sometimes this jump can make a lot of price movement that are unexpected. Sometimes you can see the trade moving a little, like moving in a very little bit, and before you know it, it then spikes. And when it spikes, it gives a lot of profits. That's why I like it. But it's not like boom. When you're trading boom, it is most like a game of levels in the market. But with jump, you can trade with any strategy. You can trade with a lot of strategy on jump 75 and even volatility too. So You can trade with a lot of trading strategies on volatility and jump, but you can't do all of that with boom and crash. Look at boom and crash here. Everything, the movement almost look very similar to each other. So what does that mean? It means that to trade boom and crash, you need to know a lot about support and resistance. And I'll be teaching you all that in the future, all these different strategies in the market, and you're going to start seeing profits for yourself, trading the market by yourself. Another thing you should know about derived synthetic indices is the time frame that you're trading these assets. In general, when you are trading the market, you know that the time frame is very, very, very important. For example, right now we are on the 15 minutes time frame, and if we go down to the 4 hours time frame, it's the same chart, but it's looking different. Why? Because the market is telling us the things that happen every 4 hours. It's giving us price movement within 4 hours. It's like this one is like the source. Like when you are going to a river to fetch water, the water you are fetching from the river is from a bigger river. So as long as the river is flowing, it has a source where it's flowing from. So from one sea, you can have a lot of rivers. Let's say, for example, river, let's say River Niger now or River Benue. River Benue is connected to a lot of rivers, and River Niger is also connected to a lot of rivers. So that's like the source for that river, for those smaller rivers. So what do I mean? This one is the source. This one is what happens in the bigger time frame. And when you break it down, you now start having the 1 hour time frame. So this 1 hour time frame is now showing you like smaller particles of the market of what is happening in the bigger time frame. Now, if you go to the daily time frame now is like the sea that provides water to River Niger. So River Niger now has a sea that gives it water, where it gets its own water from. It has a source. And every sea also has an ocean that gives it water. So that's how it is. So you are breaking it down from one particle to another. When you're on the daily time frame, you guys to be very, very careful. Daily time frame is not for beginners. It's not something that you just go there and start trading. It requires a lot of money to trade with the daily time frame alone. Although we have top down analysis and a lot of them, but if you want to trade on the daily time frame, you must make sure you have known a lot. You must make sure you have known a lot. Even on the 4 hour time frame, I don't recommend beginners to start trading with the 4 hours time frame. I will say that you should focus on a lower time frame like the 15 minutes, the 5 minutes, and if you are a scalper, you can use the 1 minute. The 1 minute is like the smallest of them all. This is where a lot of traders like to take their trade and trade boom and crash and all that, looking for the spikes. I don't really like trading with the 1 minute time frame. There are traders that they trade with the 1 minute time frame and they make their profit, but for me, I like to trade with a 15 minutes time frame. That one gives me more peace of mind to trade. I don't have to be checking my time, maybe I don't have to be checking my charts every 1 minute. And when you're trading with a bigger time frame, like 15 minutes time frame, you get more from the market than when you're trading the 1 minute time frame. It's a different level in the market. It's a different level you're playing when you're trading with 15 minutes. And when you start trading with the 1 hour, you are also playing on different levels. As long as you know what you are doing in the market, 4 hours, daily candle, weekly candle, they are there. But you got to know exactly what you want from the market. So if you are a beginner, I will advise you to focus on this smaller time frame when looking for an entry for your trade. We have something called the top-down analysis where you will check the higher time frame, you check the lower time frame before you start trading the one you like. But I'll be teaching you that in the future. Anytime you want to take an entry, make sure it's from the smaller time frame so that you can be able to risk less in the market, like the 5 minutes, the 1 minute, 15 minutes. So that's it. Now you understand the concept that I told you guys about the ocean, the sea, and the rivers. Now we have two ways of trading derived synthetic indices. Number one is trading them with price action. When I say price action, it's called naked trading. That means you are trading the asset the way it is. You are only trading with drawing lines. You know, you draw your lines, you draw your trend lines. You can draw your trend line. You see, there are a lot of tools that you can use to trade the market. Every single object that you can see here are price action tools. We use all these tools to trade price action. The rectangle, the triangle, the eclipse, the Elliott waves, everything we use them to trade price action. Price action is a very great way to trade if you know how to trade it. Some traders don't know how to trade price action. And why do I say they don't know how to trade price action? Is because they are not making profit from it. When you are trading, there's nothing like being a professional in trading. There's no professionalism in trading. If you are trading, what makes you a profitable trader is the fact that you are making profit. Nobody wants to know if you're a professional trader, if you went to Harvard to study how to trade, whether you went to Wall Street to trade, you did all of that. Nobody cares in trading. What people care about is if you can be able to make profit. That's the main thing. If you cannot make profit in the market, you are not a trader. You're not a profitable trader. You are just a trader. A profitable trader is the guy that makes profit. So if you call yourself a price action trader, one thing that shows that you're a price action trader is the fact that you're able to make money from all these things that I told you guys. You can draw with all these tools here. You can draw with a lot of tools. They are very free and available for you on MetaTrader 5. But do you know how to use them? Do you know the ways to use them correctly? That's the main thing. Nobody is telling you to pay to use these lines. It's free. You can pick it at any time. You can draw it anywhere on the chart if you like. Copy it, draw them on any point on the chart. But the main thing is, are you able to use it to make profit? How profitable is your strategy? When you trade, are you making money? That's the main question. So, being a professional trader is not the answer. Being a profitable trader should be your desire. Now, we trade with this price action strategy. There are a lot of tools with price action. Let me show you some of them. We have this rectangle here. This one, you see a lot of guys, people who trade other blocks and the rest. They use this. You can change the color to anything that you like, and that color does not matter. What matters is how much you are able to make from your strategy. So you can use any color, you can trade, you can place it at any point in the market. But at the end of the day, hope you bring profit. That's the main thing. I'm going to be teaching you guys the correct way to use these tools so that you can be able to make profit with them. Here, I'm not coming to talk, I'm not coming to tell you theories and logics and call names of different things in the market. I'm here to teach you how to be able to make profits from the market. And the best way we make profit from the market is by trading synthetic indices. Synthetic indices has given us every tool that we need to make money from the market. Now, like I said, there are a lot of tools here. Let's check this one out. This one is circle. You draw a circle on the chart and you use it to analyze the market. You can see you draw, you can use it to analyze the market. There are many uses for all these tools. It all depends on your strategy. We have another one. We have Fibonacci retracement. This one is also very important when you're trading. It's a very effective trading strategy, the Fibonacci. And there are lots of them. All these are called price action trading strategies. You are the one that use your hands to draw them on the chart. So you are not like analyzing them based on some coded metrics. This one, you are the one that is drawing them on the chart, and everything is on you here. So you cannot say that I traded with an indicator and this indicator destroyed my trading my trading life, or this indicator is not working. When you make a mistake here, you have nowhere to run to. You have no person to cry to. Nobody is responsible for your mistakes when you're trading price action. You are the one that is trading it, and you're the one that drew it on the chart. You're the one that followed it. Everything was done by you. So there's nobody taking responsibility for your actions. You cannot blame the market. You cannot blame your broker. You can only blame what you drew on the chart and the level of knowledge that you used to understand the things that you draw on the chart. Now, with that done, let's take a look at indicators, which is the second way of trading derived synthetic indices. Let's say, for example, let's add a broker, let's add an indicator. So I have a moving average line here already. So this is the moving average line. It's a very strong indicator if you know how to trade it. Let's add another indicator. Let me look for RSI. RSI is a very powerful indicator and a lot of traders like to use it. Relative strength index, look at it here. So click on it. I don't want to do some edits to it because we are not learning the strategy today, but let me just add it on the chart so you can see exactly what I'm saying. So we have added it on the chart. Now look at the RSI. Look at the indicator. All these are trading indicators and we use them to analyze. Like there are some traders that when they see the RSI get to this level here, we call this level the overbought area. You understand? Indicators are meant to make trading very simple. We call this level the overbought area. So when it gets to this point, some traders will sell the market from there and make profit. And when it touches the lower line, like for example, if you are in like here right now, if you are here right now, you can see that the trade touched this line. You understand? So depending on the strategy, a trader can use this indicator to be able to analyze the chart and make profit. Now, there's a lot of conception going on in the market that some traders only trade indicators and that traders that trade indicator don't make profit. That's a big lie. Whether you're trading indicators or you're trading price action, the goal is to make profit. The only thing that makes you a profitable trader is how how good your knowledge is How effective is your knowledge in the market? Someone can be very knowledgeable using RSI strategy. Someone might have analyzed the RSI strategy, been trading it for a very, very long time and mastered it. And the person will be making profit more than someone that is using price action and don't know what he or she is doing in the market. So it is very, very important that you focus on the one that you know best. Focus on the one that is giving you profit in the market. If your strategy as a trader, if you are trading the market and your strategy is not giving you profit, leave that strategy and look for another strategy. Some traders can just marry a trading strategy. You have been using this strategy for years and it has not given you any profit. It's always giving you losses, losses, losses all the time. And you are still trading this strategy. That is very, very bad. That is very, very wrong. Your life can change with one strategy. If you are using a lot of strategies, you're going to fail a lot. With one strategy, focused on one strategy that is profitable, you'll be able to make a lot of profit from the market. When you are trading one strategy for a very long time and everything it gives you is loss, every time you trade it, loss, please change that strategy and look for another strategy. Look for a good strategy, a strategy that is giving profit so that you can be able to make profit for the market. Don't say your village people is is on your case and a lot of that. Many people like to say that. And some people will come to forex trading and they will start praying that, oh God, please help me trade. I I I, I hate to be a bearer of bad news here, but I tell you, prayer does not work in forex trading. Yes. There are sometimes you can even do fasting and the day you break your fast, you blow your account. Yeah, it happens a lot. So what you should pray for is that God should direct you to someone that will be able to teach you the right strategy that will make you profitable. With the right strategy, you don't need prayer. All you need is knowledge. There is no amount of prayer that will make you a profitable trader. It is only knowledge that can make you profitable with trading. So you have to get the right knowledge from the right person to be able to become profitable. That is how it works. So your prayer, instead of praying that God should help you take the trade, God should help you stop the market from hitting your stop loss, and all of those emotional prayers, what you should be praying about is that, oh God, please lead me to someone that can be able to teach me how to trade effectively. And that is what you should be doing. Now, let me show you. We have a lot of indicators in the market. We have the average, we have Bollinger Bands, we have envelopes, we have Ashimoku indicator, we have moving average, we have parabolic SAR, like a lot of them. If you add them on the charts, you'll get many, many, many different parameters on the chart. You can be able to trade them, and if you want to master them, you focus on it and learn them to master them. But the main thing is to make sure that your strategy is giving you profit. At least when you are done with your analysis and you have come up with a strategy. If the strategy is working, it will give you profit. If it is not working, it will not give you profit. It's as simple as that. The fact that your trading strategy is not giving you profit is a testimony that it is not working. Because if it is working, you'll be making profit from the market. So that one is very, very important. Very, very important for you guys. So don't come and be having pride and say, this one is my trading strategy and, a lot of those stuff. But deep down inside you, you know that this strategy is not giving you profit. You will have to change the strategy so that you can start making profit from the market. You need a trading strategy that will give you real profit from the market. And now let me teach you guys a trading strategy that will help you as a beginner, the trading strategy that you can be using as a beginner. But before that, let me remove all these indicators from my chart because now I have removed the indicator. I want to teach you guys a price action trading strategy that you can use for derived synthetic indices. This strategy is very, very simple. We call it the break and we call this strategy the break and retest strategy. So we call this strategy the break and retest strategy. This strategy is a support and resistance strategy, but this is like a reverse support and resistance. In a typical support and resistance, you will have something like this where you place your line, something like this, you understand? Like right here where my arrow is, you can draw your support from there, from these 2 points, this point and this point, in order to get this point here to move up. So here is a support, here is also a support, and this is the point where you can take a trade, because for you to get a good support, you need the market to like touch 2 points in the market in order to get the third one. So when you have this, you can now trade the market. This is the typical support and resistance strategy, but this one is called a break and retest strategy. What does it mean? It means that this point here was supposed to be a very good point for the sellers to sell the market. Meanwhile, the buyers are very, very much in control of this market here. So now that the sellers are expecting the market to fall down from this point, the buyers said no. Then they now broke this. Then they now broke the strength of the sellers by trading above it. We call this the break of structure. So now they have broken this structure here. This buyer's strength, this seller's strength. They have broken this strength here. So now the buyers have moved past this place, and because of that, they have taken charge over the trade, over the market. How does this work? It's like when you are watching a war movie. So you see these soldiers, they come to the village, and when they get to that village, they start to attack everyone there. They are trying to break the force of the authority there. So sometimes after attacking everybody, they even you know take down the king, and they now build their own authority on that village. And now the village now belongs to the soldiers that attacked it. They now take dominion over the village, and they now own the village. So that's the same thing that is happening here. When the buyers have come here and they broke this strength of the sellers, this resistance, they have broken it. So now they own this point here. This place that is supposed to be a resistance is now a support. And because it is now a support, the markets can now come to that point and then move up. So there's no amount of resistance that the sellers can do at this point again, because they are now weak. They have been overcome. Even if they try anything they can, they won't be able to take over the strength of the buyers here. So now the buyers have taken over this market here, and that's the reason why you see the markets come to this point and then start moving up. And to trade this break and retest, you have to be in line with the trading trend at that point. Like for example, here you can see that the market was moving in an uptrend. You can see the lower low higher high, lower high, then higher high, lower high, higher high, another lower high, higher high, a lower high, another higher high. And that's the reason why it is very, very easy for the buyers to be able to be taking control of the sellers' positions in the market when you're in an uptrend. So when you're in an uptrend, it's very easy for you to trade this break and retest strategy. This break and retest strategy works better if you are trading it along with the trend in the market. So it's very, very simple. What do? You wait for the market to break a point like this one here. Like this one here. You wait for it to break. And then you want to see the market move past that point. If it moves like this, if they move like this little pin bar here, it has not broken it. You need to see it breaking it boldly out of the line and then return. So you see, first thing it breaks out, it retraces, then it starts moving up. Breaks out, retrace, move up. That is how it works. So when you are trading break and retest, make sure you are trading along with the trend. Now, one very, very important thing about the break and retest is the candle that comes to it. Like, for example, when the market came back to this point here, you can see that we have the bullish engulfing candle here. Look at this bullish engulfing candle. When the market got to this point, you get a bullish engulfing candle, and from there, the market start going up. So that's how it works. So this is a very good strategy for a beginner. If you're just starting up, you need to start with something, and this is something that is very, very important, very, very beneficial. Like, some traders take this as their major trading strategy, and this strategy works very, very well in the market. Why? Number one, because it's following the trend, and number two, because it indicates the strength of the buyers. So when you are following the trend, sometimes the market can change. But this one, when you see this, you know that the market has not changed yet. It just broke the strength of the sellers. Let's take a look at another example. So now here is another example of our trading strategy. So here you can see that the market was moving down in a downtrend. See this by the higher high, lower low, higher low, and a lower low. So it now moved back again up here, and here it broke this structure here, this point, the point of the buyers. So at this point, it's the buyers that are suffering because the market is moving to in a downtrend. So when the market breaks this point here, you know that if it returns to this line again, there's a guarantee that the market is going to give us what we are looking for. So when you are when you have seen that, what you do is that you draw your line on this. When you have seen this clear break of structure here, just pay attention to the blue arrow here. This is what I used to indicate this. So you see the market move down below this line here, and when it has moved down below the line, you know that the structure has been broken well. So the next thing you do is to wait for the market to return to the line. When the market has returned to the line, that is the point where you look for an entry candle to enter the trade. And as you can see here, we also had another engulfing candle. This time around, it's a bearish engulfing candle. And after it, you can see that the market moved down. That was a very, very good price movement if you are taking it. Now, why didn't we take this one? This one here. Why didn't we accept this break of structure here, this break here, this little breaks, because at this point, these buyers and the sellers are still struggling. They are still struggling in the market, trying to know who is going to win, who is going to defeat each other in the market. So that's why we don't take that type of trade. We wait for a clear breakout so that we can see the people that actually won in that trade. Before you trade, you have to make sure you understand what is happening on the charts. That's what makes you a profitable trader. That's what separates you from other traders in the market. The ability to be patient and allow the market to show you what is actually happening in the market. So when the market shows you exactly what is happening in the market, then you can now take a trade. If you enter the market blindly, full of doubt, full of fear and FOMO, the fear of missing out, you are going to miss out a lot of trades, even with that fear. And if you take a trade, you will lose it. You will blow your account. When you are trading the market, you need to approach the market with a level of confidence. You don't need to rush into the market. You don't need to act like you are the best trader. You just need to apply some kind of knowledge. Fear does not make any difference in the market. Have you ever been afraid? Let's say as your trade was going and the market was trying to hit your stop loss and you were afraid. Then because of that your fear, the market now say, okay, let me respect this guy. This guy is afraid. Let me not take out his stop loss because he's afraid. And then move up to your direction. No, it does not happen that way. If you are happy or afraid, it doesn't make a difference in the market. Everything you take in the market has its own repercussion. Whether you are happy or you were sad or you were angry, all your emotions does not move the market. What moves the market is this how it works? This is where I'm going to draw my line. This is where I'm going to take the trade. This is what I am looking for in the market to help me take this trade. That is what works in the market. You can even kneel down, bow down to God and pray that your stop loss don't get hit. And it will still hit. The angels will be looking at you and, and laughing. Because that is not what moves the market. When it comes to forex trading, you have to be knowledgeable about what you are doing in the market. So this trading strategy is going to help you as a beginner. I want you to go to the chart, start practicing this strategy and see how it works in the market. Try to analyze some trading assets using this strategy. Now we have a VIP group where I drop all my trades in the market. So here you can see that I'm currently on a trade on volatility 50, and this trade is this trade is going very well. Look at this. Look at the stop loss. The stop loss is at the top there, and look at the take profit target. So for this trade, I have risking $1,595, and I want to make $7,188. So this is the kind of trade that I give in my VIP Signal group. If you want to join my VIP Signal group, the link is in the description box below. And you can see that here we don't trade like anyhow in the market. If you see my stop loss, you will see that the stop loss is very tight. I'm not like other traders that move the stop loss to a very big level here, making 1:2 and all that. Look at this trade. The stop loss is tight and the take profit target is very, very wide. And this trade is still going and it's going to hit the take profit target. So this is the kind of trade that I want you guys to take. And this is the type of trade. And this is the type of trade that I'll be giving you guys in my VIP program. So to join us, just click the link in the description box below.